This is level 1 of the CFA program, the topic on alternative investments, and module 1, categories, characteristics, and compensation structures of alternative investments. This pretty much serves as an introduction to this asset class known as alternative investments. This particular module, note that there are only 3 LOSs and the action word is to describe. And so really we're going across the breadth like this. We don't get too deep into this. Level 2 and level 3, we'll probably have more detailed conversations. So what we'll do inside of this kind of an introductory module is to describe types and categories of alternative investments. I'm guessing that you guys are familiar, at least on some kind of a fundamental level. We'll talk about the ways and the characteristics of investment, and then probably what I think is the most important, or at least the most interesting of the LOSs, is to take a look at how specific alternative investments compensate their decision makers or their managers. So let's go ahead and start with just a basic definition of alternative investments. And to do so, I'll probably give you another one of my history lessons, and you've probably heard this before. Think about traditional investments or traditional wealth management. When we sit with clients, we're probably going to say to them, you know what, you probably need some cash. Maybe that's 2% or 4% or 6% of your total wealth, probably for emergency scenarios. And then we're going to allocate the rest, the other 95% or so, to a mix of fixed income securities and equity securities. And what we're going to try to do is we're going to use those 3 traditional asset classes to meet the client's risk and return objective. Well, wealth managers and clients, of course, over the years have decided that, sometimes fixed income securities and equity securities are not enough. Remember that all investors essentially want to do 2 things. They want to take the risk and they want to squeeze it down to a small level. They want to take the expected return and they want to expand it to a level. Those of you who've been paying attention to my videos notice I did the horizontal axis here with risk and the vertical axis there with expected return. Remember all those fun graphs that we drew back in efficient markets hypothesis and efficient frontier and security market line, et cetera, et cetera. So anyway, these alternative investment class expands the investment set, but what it does is this is an attempt to, and I'm going to be nervous when I say this, try to increase expected returns by, in addition, maybe lowering risk or at least not substantially impacting risk. Don't tell any of your finance professors that that's possible. But that's the goal of everybody out there in the investment community. So look at some of the motivations for alternative investments. All right, so diversification. Look at the second block point, enhancing returns through an improved portfolio risk return profile. That's what I was doing here and doing like this. Potentially high yields and low interest rate periods compared to traditional returns. And so this is really fascinating over the decades of, let's say 2000 through the 2020. What kind of an interest rate environment were we operating in, at least here in the United States? Essentially 0% interest rates. The Fed was determined to keep interest rates low. So alternative investments offered, at least short term, potentially higher yields because those interest rates were so low. So we'll go ahead and spend some time talking about private capital. We'll talk about real assets, and we'll talk about hedge funds inside of these 3 modules in this topic. All right, continuing along this LOS of describing, so what are these characteristics? And these are all great exam questions. So narrow specialization of investment managers. So I want you to think about this. Let's suppose that I'm Jim and I'm a mutual fund manager, and I say that I'm going to invest in a wide range of stocks and bonds. So send me your money and I'll go ahead and I'll do this. So I go out and I buy a bunch of fixed income securities and I buy a bunch of equity securities. And in the prospectus, I told you as my investors or shareholders that I'm going to do, I don't really have any restrictions. So I'm going to invest in high beta stocks. I'm going to invest in low duration bonds, and the whole spectrum in between those two extremes. But inside of alternative investment asset class, we really specialize. So we're going to find a certain type of investment that we like. So if I'm an alternative investment fund manager, I'm going to say to you, hey, I'm Jim, send me all your money, but I'm going to focus on just this area. And we'll talk about what just this area means here as we go through this slide deck. But remember, narrow specialization. Now, if I go back here just quickly, notice we want to improve the portfolio risk return profile. Well, those of you who remember the Harry Markowitz efficient frontier and the equations for the standard deviation of a portfolio will know that the correlation coefficient between and among assets plays a substantial role in determining the total risk of the portfolio. And so this is really why, and let me go back here real quickly. Again, that first block point down at the bottom, this is why we're able to diversify along this new asset class, because there is low correlation between alternative investments and fixed income securities and equity securities. Those of you who read the Wall Street Journal regularly, and I recommend that you do it on a daily basis like I do, will read almost on a weekly basis about a regulation that was imposed on one particular industry. So there's lots of regulation out there. In fact, I'll go ahead and date myself here. And this particular recording, Aaron Judge just hit his 61st home run and 62nd home run, and the people who caught the ball, they're faced with some tax liability. So we have this alternative investment, right? This is a collectible. It's a baseball. It's probably worth $10 or something as just a regular old baseball, but now it's a home run baseball. A baseball that will be remembered for the rest of time. So now it's worth $2 million. What are the tax implications? What are the tax regulations? And what are the secondary market regulations? I mean, you can envision someone coming along and saying, oh, you're not allowed to trade that but once a month or something. I'm making that up. All right. So less regulation and less transparency. And then, of course, how many home run balls have been hit? So there's limited historical return data, which means that you're probably less likely to be able to compute historical risk data. There we go, unique legal and tax considerations. I said that. Higher fees, concentrated portfolios. So that swings back up to the first teardrop point. If we have a narrow specialization, then we're probably not going to have diversification inside of that specialization. But, and let me go back here, make sure you get this. The diversification here is for the total portfolio. So our client has cash, fixed income securities, equity securities, and alternative investments. And so viewed from the portfolio perspective, that's an increase in diversification. However, inside of the alternative investments, you can get super concentrated. And then remember, if I'm just a regular old mutual fund manager, which I was suggesting to you up in that very first teardrop point, I say to you, send me all your money, and whenever you want your money back, I'll be happy to send it back to you as quickly as possible. Well, in this alternative investment universe, it's not quite as simple as that. In fact, if I'm a hedge fund manager, let's say, I might say, hey, send me all your money, and I'm going to invest it in maybe these concentrated portfolios that have low correlations with your fixed income and your equity portfolios. I'm going to invest it in those, but boy, some of these investments don't have lots of liquidity. Maybe I'm going to invest in how about if I come up with a crazy example? I'm going to go along the East Coast in all the boardwalks, and I'm going to buy up 50 miniature golf courses. So I take your money, I buy up these miniature golf courses, and maybe I manage those, maybe I hire someone to manage those for me. But if you want your money back, I'm not going to be able to give it to you because it's tied up with an illiquid asset, right? A miniature golf course. How liquid is that on the boardwalk in Ocean City, New Jersey? I have no idea. All I know is that I've played tons and tons of miniature golf along the East Coast. So there are restrictions on redemption. So I think this is a really good slide to know and to be able to answer some really clever multiple choice questions. All right, I've already mentioned just a couple of categories here, but let's go ahead and take a look at what this module, how this module divides alternative investments. And there we have green and purple and blue. So private capital includes private equity, private debt, and venture capital. Real assets include, anything that you can, wrap your hands around. Real assets like maybe an apartment building or a miniature golf course. And then infrastructure projects, we'll talk about that in just a few slides, where we have some kind of a partnership between maybe a local municipality and a local construction company to go ahead and repave Main Street because it has bunches of potholes in it. And then natural resources, of course, commodities, things like oil and gold and anything else that you can think of back in our conversations with derivative securities, especially those futures contracts. Agricultural land, of course, we can use some of our investments to go out and buy a farm, and we can become farmers. And then, of course, we need 2x4s to build our houses and our buildings, so timberland. And then hedge funds, I did mention myself as a potential hedge fund manager there, where hedge fund managers essentially say, send me your money, I'm going to do whatever I want with it. Now that's a pretty silly extension of what hedge fund managers do, but the hedge fund managers have lots and lots of flexibility. I mean, a hedge fund manager is not going to take our money and go bet it on number 23 on a roulette wheel. That would probably not be consistent with what the SEC deems a reasonable and prudent investment. But hedge funds, they can invest in private equity and private debt. They can invest in miniature golf courses. They can invest in collectibles. They can invest in forestry. They can, pretty much have the gamut of all of the alternative investments. Now, here we have a couple of slides that go into just a little bit more detail than what I just described. So private equity, probably what we're going to do, we can invest in lots of startup companies. There are television shows out there that say something like, hey, come on our show, give us your idea, and we'll decide whether or not we want to make that investment. So startup companies or established companies that are not listed on a public exchange. But then you can find public companies, probably smaller public companies, but it doesn't have to be, with the intention of going private. So look at that second box point. This is probably important there. Primarily involves leverage inside of this transaction. Now, we could have an LBO, right, a leveraged buyout or a management buyout. We could do those kinds of things. But remember that there's probably some leverage involved. Venture capital funds, these funds almost always invest in startups, or at least those companies who maybe have a product line and they may have a prototype, and maybe they have, some kind of elementary manufacturing system. But the important part of that is, look at the very last two words there, growth potential. And then private debt, you can do this through direct lending or mezzanine loans, where you chop it into different sections or different slices, or venture debt. Real assets, this is probably an obvious slide for you. Direct or indirect investments in buildings, land, or miniature golf courses. This can be commercial real estate, debt, and equity. So remember, it's both sides of the right-hand side of the balance sheet there. Infrastructure, I was telling you about roads. Look at that second block point there. Associated with public-private partnerships, where if I'm Jim's construction company, I may be approached by the city that says, "Hey, Jim, we want to redo this particular road. We want you to scrape it, and we want you to dump it somewhere else, and we want you to make it nice and smooth. And by the way, if you feel like putting in new traffic signals and walkways and all those kinds of fun things, let's have at it. And so, this is a partnership where the public officials get together with this firm, Jim's construction company, and we take a look at the road and we decide, all right, what's the best thing to do? What are the needs of the citizens of that area and all the people that use that particular road? And so, boy, if I'm Jim's construction company, and I have a great relationship with the local mayor, and the mayor has promised me, all these kinds of contracts, well, then I'm ripe candidate to be taken over, or at least a candidate for venture capital or private equity or whatever it is. Natural resources, of course, we can do this directly or indirectly with a futures contract. And then others down there. Look at the bottom. This would have been my example with the Aaron Judge home run ball. Artwork, collectibles. This fascinating thing about artwork. I'll go ahead and use the example of one of my favorite comedians of all time, Steve Martin. I think Steve spent hundreds of thousands of dollars on a piece of artwork, and it was discovered that it was a forgery. And so somehow, some really talented artist, redrew or re-arted, whatever the word is, and actually ended up selling it. I don't know what the end result of that was. I tried to find something, but I think Steve still has this. And as you can imagine, he probably makes fun of himself and says, "Oh yeah, I spent all this money on a forgery." So this is one of the risks associated. Remember earlier on in one of those slides we talked about that risk-return relationship. But if you go to the floor of the New York Stock Exchange and you buy shares of McDonald's, you pretty much know that that's probably very likely an actual share of McDonald's, and you don't have to worry about forgeries. But in this collectible market, this is a big risk. Coins and stamps, Hollywood memorabilia. Years ago, I had my students my MBA students do kind of a research project on alternative investments, and one of my students came up with, knowing that I'm a James Bond fan, came up with the swimsuit that Daniel Craig wore in that great Casino Royale movie in 2006. And it sold on eBay for $18,000 or something. And I was like, hey, this is a great idea. You buy it $18,000, and then when Daniel Craig retires from James Bond, you sell it for $36,000 or whatever it is. And then there are other intangible assets like patents and copyrights and those kinds of things. Hedge funds. Look at the bolded up there, what we have written. Different strategies to manage portfolios. So this is what I was saying earlier, that the hedge fund manager can pretty much do what he or she wants to, as long as it's spelled out into the prospectus. So, of course, they invest in traditional assets, but they invest in all sorts of alternatives. But the cool thing about hedge funds is that, with traditional stocks and bonds, they can take short positions in there as well. And so they can do long-short strategies. And we'll talk at length about that in another module. Can be highly leveraged. That makes sense. And look at the last bolded words, specialized approach. So this goes back to what we were saying about the diversification and the concentrated portfolios. Remember, alternative investments are not, let me repeat that, are not to be invested just by themselves. They have to be part of fixed income and equity securities. All right, we can do direct investing. This makes perfect sense. So let's go back to my example. Well, who was I? I was Jim's construction company. And so what could a private equity firm could come and say, hey, you know what, Jim, we think your company is worth $20 million. Here's a check paid to the order of Jim, $20 million. And by the way, Jim, we want you to stay around and help us. We're going to bring somebody else in, but we want you to stay around and help us build all these great roads. So, real estate is also a good candidate for this. Great exam questions here. Notice the LOS, describe the characteristics. All right, so advantages and disadvantages. These are great exam questions. So no payment of management fees, flexibility, highest level of control about how the asset is managed, right? So what was I saying earlier, that the private equity firm might say to me, Jim, we want you to stay around. We're going to bring someone along, and the two of you are going to increase the value of your company over time. And I might say, you know what, I think this is a great idea because, I'm tired of building roads. I've been doing it for 100 years and I'm ready to get out, but I'm happy to stay on for a little bit longer. Disadvantage, so there's the requires more investment expertise. So the private equity fund is going to have to know how to value my company. What number did I come up with? 20 million. Well, that better be a fair price. It better be a price that if other people over here came and evaluated my company, that they would come up with a number that is pretty similar. So lots of investment expertise, which is what the Institute is trying to teach all of us by looking at things like, remember we had a reading on cash flow predictions, right? And standard deviation and beta. And so you need to combine all of those things to be able to identify and value a company. Yeah, well, that means greater level of due diligence, because if we invest on the floor of the New York Stock Exchange in shares of McDonald's, we pretty much know what McDonald's is and what it does, right? The French fries and the hamburgers and the McNuggets. How much due diligence can you perform? I mean, of course, you would go through the financial statements and you would come up with perhaps your own ratios and compare the market value of McDonald's to our own estimate of market value. But that's a lot different than trying to value Jim's construction company or 20 miniature golf courses along the East Coast. Higher level of minimum capital required. One of the assignments that I give my undergraduate students is we have the Morningstar software on all of our computers in the finance trading lab. So we get that Morningstar software up and I tell them to go find a mutual fund and tell me what the minimum investment is. And some of them say 3,000, some of them say 2,000, some of them say, hey, look, if I agree to deposit $100 every month, then that's all I have to do. It's not true with alternative investments. So there's higher level of minimum capital requirement. And so think about this: if we're getting ready to invest and we're getting more experience, what does this say back here? Greater level of due diligence. As we become more and more expert on these kinds of investments, we might want to go through co-investments here. So investors learn from the fund process, reduce management fees, and it allows more active management. And so, think of, this is my sports analogy. You think of the difference between the number one draft pick for, whatever professional league it is. This number one draft pick usually comes in and they're super excited and they say, here, let me learn this, let me learn that, versus a veteran who's been there for 10 years who knows all of this stuff. So it allows for more active management, and the learning process is, I'm going to go ahead and say it's fun and exciting. Disadvantages, there's probably a little bit less control over the selection process. There might be this adverse selection bias. Remember, we talked about, let's go back to Harry Markowitz in 1952. Let's go back to Modigliani and Miller in 1958, and even William Sharpe in 1964, and a lot of other of these founding fathers of finance. In their models, they assumed this thing called homogeneous expectations, which essentially means that everybody has the same information set and they process that information set in identical ways. And so no one has an information advantage. But adverse selection bias means that somebody knows more about it. Let's suppose that I'm the 10th owner of the miniature golf course, and I know there's a private equity fund that's going and buying the 9 golf courses above me, and they get down to me wherever I am in Delaware or Virginia. And I know what they were looking for up there, and I know my miniature golf course is not the high quality of those. So I quickly go out and I vacuum, I plant a tree or something, I make it look look like it's more valuable, so then they're going to overpay for me. So remember that adverse selection bias. Yeah, it can require more active involvement compared with just regular old fund investment. All right, so fund investment here. This is where we just contribute to a fund, and then the fund manager does all of the decision making. So the fund manager then offers investment services and expertise, lower level of investor involvement, right? You can just send your money out there and then essentially not worry about it. And it gives access to alternative investments. I mean, let's face it, unless you were the guy out there who caught the home run ball, you don't have access to that home run ball. And if you want to buy it, you'll have to pay, let's say, $2 million. But if you invest in a fund that concentrates on, let's say, sports memorabilia, well, then that fund manager can go ahead and have access to that market, even though you didn't have to send $2 million into the fund. There you go, lower minimum capital requirements. The flip side then is if there's a lot more hard work involved and greater access to these alternative investment markets, well, then it probably costs more to run the fund. So costly management and performance fees. And then the investor ought to perform some kind of due diligence before selecting the fund. All right, let's talk about how some of these funds are structured. And so let's think about this. Let's suppose that I'm Jim and I'm the general partner. And there are 10 of you out here watching this video. Boy, I sure hope there are more than 10 people watching this. And you 10 are my limited partners. So here we are. I provide some capital, right? And you guys provide capital. And the interesting thing is that each of you doesn't have to provide the same amount of capital. One of you might send 10 million to me. One of you might send 12 million to me. One of you might be an insurance company and you might send 50 million to me. Right, so I have this huge amount of money. Let's just suppose I raise $1 billion, just so we can do some quick math here in a slide or two. So I raise $1 billion, so we have this limited partnership. So I'm the general partner, I run the business, and I have unlimited liability. You guys play the passive roles, and you're probably accredited investors. The module doesn't really explain this very well. You probably know this maybe even better than I do, but an accredited investor is kind of a financial services industry cool way of saying that you're probably pretty wealthy. You have to have $1 million worth of net assets or net worth, whatever that you want to call it. You have to have some kind of an income, $200,000 or $300,000 a year. So accredited investors are, ultra high net worth investors, but they can also be pension funds. What did I say earlier? Insurance companies or trusts. This is what I tell my finance students all the time. I say, look, this is what you need to do. You need to grow up and become a trust fund manager at an investment banking firm, because every day somebody throws their money at you and you get to pick what you want to do with it. So of course you're going to invest in bonds and you're going to invest in stocks, but think of how cool it is for you to be a fund manager that has access to this alternative investment market so that you can go out and buy miniature golf courses if you want. Now, this relationship is governed by an LPA limited partnership agreement, which pretty much outlines not only what the responsibilities of the general partner might be, but also outlines the compensation structure, which we'll talk about here in just a second. And there might be side letters in there, agreements created between the general partner and some of the limited partners. And this might have something to do with things like, in case we have to liquidate, or in case we come across an asset that substantially increases in value over a short time period, then the limited partners might be consulted of what to do with it. All right, compensation structure. So I'm Jim, I'm the general partner, and so I'm probably going to charge a fee. So what did I say earlier? I get, we had a $1 billion, right? So I'm probably going to have this management fee. Sometimes it's called a base fee. and it's going to be based on a percentage of the assets under management. And so what's, if we have $1 billion and my fee is 1%, so what's 1% of $1 billion? So that's, what's say 1 or 2%, so that's $1 or $2 million, right? So that's my management fee. But then what you guys want me to do is you want me to generate some kind of a return. So there'll be a performance fee, that's called carried interest, which has its own unique political ramifications. If you're not doing anything, the next time you have a minute and you don't know anything about this, just type in politicians' attitude towards carried interest. And boy, this is scandalous kind of a conversation. So these performance fees then are based on excess returns, which are determined by a hurdle rate. So just think of a hurdle rate. Suppose my $1 billion fund has a hurdle rate of 10%. So let's suppose that I take our $1 billion and I turn it into $1.1 billion. So that's $100 million. That's 10%. If our hurdle rate is 10%, well, then I delivered that 10%, and then I don't get a performance fee. And there are hard hurdle rates, and then there are soft hurdle rates. Most of these funds have the hard hurdle rate, and then there could be consulting fees and monitoring fees. And so what happens then is that suppose that I, instead of turning the 1 billion into 1.1 billion, I turn it into 1.2 billion. All right, so I hit the 10% hurdle rate, but then from the 1.1 billion to the 1.2 billion, that's the excess return. And so I might get 20% of that. I might get, some other, it's usually 80-20 of that extra performance. And so what's my incentive? My incentive is that I don't get any of that performance fee unless I exceed that hurdle rate. And this module presents this in a super simple form. I think we get into more details at level 2. So what I'll say is know just the basics here, and then ... to be continued as we move through the program. So a couple of definitions here that you need to know. Catch-up clause. The general partner can receive 100% of the performance fee on returns above that, but there's a catch-up clause that allows the GP to catch up, and so a lot of times this split is 90% and 10%. The high water mark here. Let's suppose that let's go back to my example. So I got to the 1.2 million. And the limited partners, they paid me my performance fee. And then all the miniature golf courses, nobody plays miniature golf for a while. And so the portfolio at the end of the next period is down to, let's say, 0.8 billion. Well, if I go from 0.8 billion then to 0.9 billion, I might say, hey, look, I made you another 100 million. And you're saying, wait a minute. We don't want to pay you a performance fee because you need to get back up over whatever that high water mark is, the highest value used to calculate an incentive fee. And then there's a waterfall, and this is the allocation to the limited partners and the general partner. And so just think of these as buckets. You can think of it as a cascading waterfall, but once the first bucket is filled, then it tips over and goes into the second bucket. I think a great question. And by the way, there are 15 really good questions at the end of this module. Some of them are so simple that you hope you get these on the exam. But I think an interesting one is on the difference between the American or the European waterfall. So the American waterfall is a deal by deal. So going back to my miniature golf course example, we would have a hurdle rate and a high water mark and a waterfall clause. We'd have everything for the first miniature golf course and the second miniature golf course and the third. And so these would be individually, right, deal by deal, or the whole entire fund. I mean, when I did my quick math there earlier, I was just assuming European waterfall. And then there's a clawback clause, gives the LPs the right to reclaim a portion of that performance fee. And so this occurs sometimes. There's an incentive fee that is paid to the GP or claimed by the GP on unrealized gains. This is a huge deal politically, at least here in the United States. Some politicians want to tax unrealized gains, which would have a whole set of new implications for those of us who worry about tax liabilities, which should be all of us here. So that takes us through Module 1. Pretty simple stuff. I do like the simple fact of combining this particular module with all of our traditional viewpoints that the founding fathers of finance gave us. So remember this, the LOS 1 and 2, think of them in the context of cash, fixed income, equity, and then alternative investments out here. Think of the entire portfolio approach. You'll be able to go ahead and get through those first two LOSs. And then the compensation structures, remember, these are pretty basic in this reading. Just be able to define and describe those. Those probably have the higher probability of showing up on the exam. So what did I say just a few moments ago? Go look at those 15 questions at the end of this module. I'm guessing that you ought to be able to get, I'm telling you, 12 or 13 of them correct just by watching this recording. So thanks for watching. Have a great day and good luck studying.